The second policy that the firm was considering was repurchasing shares and not issuing a dividend instead. And so what they'll do is they'll go to the open market and repurchase shares with the excess cash. So first thing we want to figure out is how many shares can actually be repurchased. Well, we know that they have $20 million in excess cash. And that each individual share costs $42 per share. So that tells us that they can repurchase 0.476 million shares. So since they started off with 10 million shares, and they bought back 0.476 million shares, they will have a total of 9.524 million shares outstanding after the share repurchase. So let's take a look at what their market value balance sheet looks like. They had $20 million in excess cash before the repurchase. After the repurchase, they didn't have any. They still have other assets worth a total of $400 million, because that was the value being generated by the company's free cash flow. And so before the repurchase, the total market value was $420 million, with 10 million shares outstanding. That gave us a share price of $42 a share. After the repurchase, that 20 million in excess cash is gone, so the total market value is 400 million. But now, rather than having 10 million shares outstanding, we have 9.524 million shares outstanding, giving us a share price also of $42 per share. So we want to know what Speaker City's future dividends will look like. After the repurchase, the company is still going to be generating $48 million in free cash flow. All they did was get rid of excess cash, so they're not harming their ability to operate at all. And there are 9.524 million shares outstanding. So dividends per share is $5.04. What will the share price be after repurchase? We have $5.04 in dividends per share. Take that at a 12% perpetuity, because the company will be able to offer $5.04 in dividends every year from now on. And we get a share price of $42 per share. So that's the same thing that we got when we were looking at the market value balance sheet. We just kind of used a different approach to take a look at it here. So our implication here is, in perfect capital markets, an open market share repurchase has no effect on the stock price. The company decided to repurchase shares. Before they repurchased shares, they were selling at $42 a share. After the repurchase, also selling at $42 a share. Also, the stock price is the same as the cum dividend price if a dividend were paid instead. We know that the price cum dividend was $42, and so here we haven't created any value by repurchasing shares instead of issuing the dividend.